In this general pool example, we will have an opening balance for our pool on the 1st of July 2020. So we set the date, we go in, we create our asset group. So general pool, it's for a business, non-primary, and it is a general pool. Fix that date back to the 1st of 7th 2020 is what I mentioned, and we're going to put in an opening balance in here of 180,000, and we need to add the assets in, because if we ever happen to sell any of the assets, we'll need to have the assets in the pool to recognize the sale. The actual underlying asset added in for a pool doesn't change the value of the pool. The value of the pool is the value of the pool in the case of an opening balance. So here we can see we've got this asset which is quite old. It's been in the pool for a while. And let's have a look and see how that pool looks. So you can see it's got its opening balance. That's the asset that's in the pool should you ever need to sell it out. And here, as you can tell, under the new depreciation rules, the balance of the pool is written off. Anyway, let's add another asset into this pool. So this asset will go in during the year. Parameters on the pool added during the financial year. Decent cost on the thing. Taxable use percentage. And if we look at the balance of the pool, so you can see the cost, the opening balance getting written off, and the cost of the new asset that's added during the year going into the pool and also getting written off. So essentially the full value of this pool being written off. So we've updated our balance sheet and profit and loss to reflect this new reality. There's the opening balance on that pool, obviously the closing balance on the previous financial year, no balance at the 30th of June 2021. Bearing in mind that we're using the tax values in the accounting reports. This might not be to your liking, in which case you'll have to keep a separate set of depreciation records for the accounting purposes as opposed to the tax purposes. So there's our 600,000. It's our 600,000. Now let's import this report. I'll just take out my previous example and let's bring in this report. I'll just save that. See how this looks. So depreciation, general pool depreciation, balance sheet which will have no value on the general pool. Now we can have a look in, or actually double check your classification first. General pool and general pool, right? So now we can have a look at our form and see how this has come through. Right, so in the profit and loss, you'll want to read that, right? Read that, especially if you're using the general pool or small business entity rules. So you've got the full 600 written off there, right? Of course, that'll create a big loss. And in the reconciliation section, unlike with non-SBE, where it creates an add back on the non-deductible accounting depreciation, and then strips out the tax depreciation through here. This doesn't work like this with an SBE entity. With an SBE entity, the rule according to the ATO is you simply reflect your depreciation in here, your tax depreciation, and there is no adjustment through the reconciliation section. If we have a look in the depreciation section, is it a small business entity? Yes, right. And then you'll see the whole schedule changes and we get that deduction for the general small business pool.